If you divide the gold price by the dollar index DXY and plot it on a chart, the resulting ratio measures gold's value relative to the strength of the US dollar. This ratio suggests three things. First, gold's true strength. The ratio shows how gold is performing independently of the US dollar's fluctuations. If the ratio is rising, gold is outperforming the dollar, even if gold's nominal price isn't changing much. 2. Inflation and safe haven sentiment. A rising ratio may indicate a strong demand for gold as a safe haven asset or as protection against inflation, regardless of dollar's strength. 3. Dollar's influence on gold. A falling ratio suggests the US dollar is strengthening relative to gold, possibly due to rising interest rates or a strong US economy. The ratio of the gold price to the dollar index is a powerful tool to understand gold's true performance. The question here is, what does dividing the gold price by the dollar index tell us? It strips away the direct influence of the dollar's strength on gold. We know that the dollar and gold usually move in opposite directions. However, this ratio helps us see whether gold is truly strong or just reacting to a weaker dollar. Let's take a look at the current trend. Since October 2023, the gold to dollar index ratio has been steadily climbing. This means that even though the dollar index has strengthened over the past few weeks, especially after Trump's victory, gold has still dominated. That's a sign of real strength in gold's position as an asset. To put this into perspective, the last time we saw such a strength in the ratio was back in August 2011, when it hit 25.75. At that time, gold was at its historical peak, and there was significant global economic uncertainty. But fast forward to November 4th, 2024, and we have actually broken that record. By studying this ratio over time, you can get deeper insight into the interplay between gold and dollar, helping you make better investment decisions. 2008-2011 Uptrend Global Financial Crisis. The 2008 financial meltdown caused panic, leading investors to turn to gold as a safe haven asset. Quantitative easing QE. Central banks, especially the US Federal Reserve, initiated QE programs, flooding the market with liquidity and weakening the dollar, further boosting gold. Economic uncertainty. High unemployment, banking collapses, and volatile equity markets drove gold prices and the gold to dollar ratio to record highs. 2011 to 2015 Downtrend. By 2011, economies began stabilizing. The US dollar strengthened as confidence in financial market returned. Federal Reserve tapering. In 2013, the Fed signaled it would slow down QE, leading to higher interest rates and a stronger dollar, which made gold less attractive. Decreased safe haven demand. With reduced economic uncertainty, investors moved back to equities and other riskier assets. 2016 to present. Gradual uptrend. Geopolitical uncertainty. Events like Brexit, trade wars, and the pandemic renewed interest in gold as a hedge. Low interest rate. Central banks globally kept rates near zero, reducing the opportunity cost of holding gold and boosting its appeal. Weaker dollar period. Fluctuations in the US dollar due to rising deficits and political instability made gold more attractive, causing the ratio to rise. The situation in 2023 unfolded differently than in the past. Despite the Federal Reserve's strict tightening policies, gold and the stock market rapidly surged, starting in October 2023. The continuation of the trade war by Biden against China, sanctions on Russia, and a sharp increase in gold purchases by central banks put immense pressure on the price of this precious metal. Since November 2024, following Donald Trump's victory and the possibility of the inflation rising again in 2025 and 2026, the gold to DXY ratio has slightly declined from its peak, with a challenging future ahead, including an intensifying trade war and Trump's less than amicable relationship with Federal Reserve Chair Powell. It remains to be seen which direction this ratio will take. If you like this video, please give it a like, and if you have any comments, feel free to write them down for me. Thank you.